Welcome, everybody. This is Prashant Kumar from Cashflow Champs. We are going to today talk about the debt terms in multifamily. My name is Prashant Kumar. I'm a certified commercial investment member, CCIM. And here at Cashflow Champs, we are helping investors gain financial freedom through passive investments in real estate. Having said that, I'm not an attorney or a financial advisor. I'm not giving any advice. The purpose of this webinar is for information purposes only. We all should seek professional advice from appropriate personnel when we are doing some investments. I am married, 2 kids, live in Long Island. I'm managing partner at Cashflow Champs. I've been an IT consultant for 25 years. I don't do that anymore. Our total team portfolio is about 150 million, about 1646 doors under management. We have a real estate podcast. At one point I had about 2,000 units. Currently I own about 1,000 units myself. I love helping others, love multifamily. I love assisted living space also. I do meditate regularly for last 35 years. I'm not that old, but I started meditating when I was a small kid. So I meditate regularly. I help others to meditate. That's my passion. At Cashflow Champs, you want to talk to us more, maybe take the screenshot here. Basically, we have underwriting sessions, which are free on Saturday at 4 p.m. One of our partners have been running them for the last couple of years. Those are free underwriting sessions, one of the best underwriter in the country. In addition to that, we have an inner circle. And if anybody wants to know more and speed up their real estate journey and want to talk to us, it's a very small group. We don't take everybody. We take only folks who are ready to jump into multifamily and move faster. So we take them under our wings, we work with them, we do deals with them, and we guarantee that you will do a deal in 1 year. Or we will continue to coach you for as long as it takes, as long as you are putting efforts. So in this webinar today, we are going to talk about loans, right? We are going to talk about finance brokers, different debt terms, different debt options. Carlos, thank you so much for joining. And we'll review the finance metrics that some of these brokers send. We will review some term sheets, and we will answer any questions that you may have. So what is multifamily? How do multifamily loans are basically taken? They are taken primarily based on cash flow, because any stabilized asset, banks wants to see whether there's a debt service coverage ratio, which is annual NOI divided by annual mortgage, that is greater than 1.25 or not. So bank wants to see that, right? Bank wants to do these loans are LTV loans. Bank may give you 75, 80% of the value of the property. There are some banks, local banks who may offer you loans with 15% down, but mostly 75 to 80%. But over the last 2-3 years, things have changed. We have seen the LTV for the financing is anywhere near to 55 to 60% or 65%. So banks look at your cash flow of the property. They do the LTV loan. They want you to put your skin. They look at borrower's credit. Obviously, they check your FICO, they check your bankruptcy, they check your liquidity, and each loan has net worth requirement, right? So bank wants to see, so basically bank want to make sure that you are not coming to the properties where financial records are poor, property is poorly maintained, or it's a weak market, right? So that's an important thing when you go and talk to the bank. You just make sure that you have stronger financials. So when you start a loan with a bank need to see the deposits before they even start working on your file, right? And they want to see all your T12s and rent roll and OM. And based on that, they would do the underwriting of the property. They underwrite the borrower. And once property underwriting and borrower underwriting is done, banks start spending money. They order appraisal, and they order inspection, they order environmental, they order title or termite, and they keep on doing underwriting. So basically, they ask for more documents. And then once all that is done, then this goes to the loan committee, and from loan committee, basically, it goes for approval. This is a normal process. If some of you are real estate investors, you already know some of it, but good to have a refresher. But what are the different kind of loans? There could be hard money loans, or there could be promissory note, or there could be agency loans, right? You can go to the SBA. You can take the loan from the local banks. Local banks can give short-term loans. They can give you 3-year loan, or they can give you a long-term commercial loan up to 10 years. They have bridge loans, basically, where you are only paying interest only or higher interest rate, provide 100% of the capex. Then you have construction financing, but they are a little bit difficult to get. In addition to that, you have U.S. government agency loans like FHA, Fannie Mae, or Freddie Mac. These are primarily for five unit plus, where the DSCR of the property is greater than 1.25. Low fixed interest rate for these U.S. government agency loans with some IO payments. These are non-recourse also. And there could be options like seller financing or master lease, or you could go for crowdfunding also. So these are some of the things that you could have. But the most important thing today we're going to talk is about the debt terms, right? I mean, when you are buying a multifamily project, when most likely you are going to buy it either through a bridge loan or through an agency loan. If it is through bridge loan or agency loan, whichever way, I think the most important thing is to see how you can find a best loan. And for that, I would suggest that we should always look for a finance broker, right? These are different kind of loans available. I mean, you do 1 or 2 loans in a year. These finance brokers are doing upwards of 10 to 20 loans in a year. So they know the market. They know what lenders are looking for in a changing environment, how lenders' metrics are changing. So they can give you those matrices pretty fast. So the role of finance broker is to go out there, look at first to underwrite your property from a finance standpoint, how much is the DSCR, and based on DSCR and capex for future DSCR and future cash flow, they go out to the market and try to get some debt terms from various lenders. So we are going to talk about that today. Let me share my other screen, where I could see some debt matrices, basically. If you see here, I mean, I'm showing a screen where basically important thing is, when you go to a broker, let's say, in this case, Greystone, they are the lenders, and they find basically debt. If you have gone through a broker who has gone to Greystone, broker is going to give you this initial metrics after looking at the property. So let's say Greystone, we send our information to the broker sent it to Greystone gave us, they did initial underwriting. This is called initial underwriting, and they proposed few terms. If you look at it here, these are all agency loans, right? One is 10-year fixed, another is 5-year fixed, and then third one is also 5-year fixed. These are different in their terms. You have amortization of 5-year IO, then 30 years amortized, right? It's a 1-year IO and then 30-year amortized. So estimated rate at 5.6, 6.0, 5.66, right? Minimum underwriting rate, that's what they have their parameters, right? Prepayment penalty, 9.5 years standard, 4.5 years. So different kind of loans. Basically, so if you look at, they do some initial underwriting, and I'm just sharing it basically for information purposes only. They have looked at your property, and they have done what is the purchase price, how much they're going to give, what is the reserve that they are going to do, right? And basically, they are even talking about the closing costs, right? I mean, finance fees, application fees that they're going to take. And so basically, they are saying that if we give you 8.636, this is going to be cost, and basically you have sources and usage. $15 million the purchase price. The total use is 15.18. So they give you the whole thing. It's really awesome way of putting a debt metrics. Your total use is 5.18. Total cash required in this case this was a 10-year loan, right? And these are 2 5-year loans. So cash required to close is 6.9, cash required to close is 6.7. And they do the basically overall pro forma, basically gross potential rent, ancillary income, so percentage occupancy today, effective gross income, annual expense. They do all this analysis and come up with these metrics where they want you to pick up what is the best option. If once they have given you the interest rate and they have given you the proceeds, cash to close, and the proceeds, then you would go back and do the underwriting and see whether these numbers are making sense to you or not. Another one which I wanted to show you, if you see here, in this case, Greystone did the whole thing, right? I mean, they did the little bit of underwriting. They put together everything correct for you to begin with. But if you see here, maybe broker doesn't want to do all that. They want to share, they have, what are the availability, right? So they will, once you send them the property package, they will come back and they will say, these are our options, okay? We have 5, 7, 10-year option, fixed, and we have floating options also. This is the index is basically cost of the capital for the lender, and then the spread is what they want to make on it. So overall interest rate is this, years of IO, 1 to 2 years, 2 to 3 years. Remember, a lot of it are negotiable also with the lender. It's not that, I mean, you can go back and forth with the lender and can negotiate your price, your LTV. Usually DSCR, no, they don't negotiate on DSCR, but LTV you can negotiate, you can ask amortization. They have standard parameters, 95% of them are fixed, but there's some wiggle room because they also want your business, right? So these brokers try to facilitate that conversation with the lender for you. Brokers, that's the purpose of that's the role of the broker in the transaction, is go look for best term sheet for you. So what I was saying earlier was, we should always be looking, unless you have done business with the bank already and you like them, and you know that they give the best term, then you can go directly to them. But if you have not done that, our suggestion typically, I mean, we have not done a deal yet in which we have not gone through a broker. Broker do make money, but that's why they get paid. They get paid and they do work for you basically on this. So the various debt options, the various companies, and you may not have access to these companies. I mean, so, and that's why the broker is, you would go to a broker and you send a referral to any broker, we are ready to refer you to them. But if you see, and when they go out, they typically have, because they have multiple deals going on at the same time, right? So they will know, okay, even before you putting an offer, if you go to a broker and ask for what is going on in the market, they may send you something like this, not commitment, what lenders are looking, what lenders are proposing, right? All in rate 5.82, 5.7, 5.77, all three agency loans, so they can do preliminary analysis and then basically give you various options. That happens all the time with the brokers. And important things are your LTV, your DSCR. See, these are kind of fixed. In this case, LTV is 75. This is an older property, so nothing is available at 75 from agency right now. Agency are probably 65 to 70%. But depending upon the property, these things could change, right? But normally these are the terms that they propose. So let's see what are the next. So once broker has given you this, you would go to the next step. You would start the process with them. Earlier, as I said, once you have had a conversation with the bank, you liked it, and then they would send you a letter of interest. Basically, they'll send you a letter of interest because lender has to do the underwriting also, right? So lender will send you now. Initially, it was a matrix. Now, lender will send you a term sheet because they want to make sure that So I'm showing you a term sheet from the lender, which is called nothing but letter of intent, and they have done preliminary due diligence at a very high level, and they think that they would like to basically, and I'm just removing these for privacy reason perspective. They would like to underwrite the guarantors. They would like to propose what kind of loan they're going to propose. Is a non-recourse loan? Who is the guarantor? And what is the guarantor financial commitment, minimum net worth? Typically, in any loan, bank wants minimum net worth equal to the loan amount of what we are asking for, right? So there could be multiple people, as you saw here. We had multiple people in this loan, multiple names. So their combined net worth was equal to 14 million, and bank wants some liquidity. In this case, they are saying 5% liquidity. Typically, it is 10%. And they say that this is our collateral, this is our property that we are going to propose. And they say initial loan amount is based on their underwriting, which is at 73% LTV. It should be at least 75% of the appraised as value, and 5.5% minimum in place debt yield, right? So that's what they are proposing. Originally, first we saw the metrics where the numbers are, and then now it is more of a term sheet, even now it is not a commitment from them because bank has not done the full underwriting. They look at the future loan amount, which is your capex basically, and they tell you, various options. They give you with all the clauses in this loan. So like interest rate, they want 4.8 million to come from the partners. Interest rate is 3.75% plus 1 million plus 1 month SOFR basically. So 3.75 plus 1 month SOFR. Interest rate is payable in arrears. They tell you everything. Loan terms is 30. So this is a bridge loan, by the way. This is not a agency loan. Extension option is a 3 plus 1 plus 1. So 36 month plus 2 1-year extensions, right? No prior events of default, payments of extension, minimum occupancy. They just want all these things written in your term sheet, and amortize, 36-month interest only and 30-year amortize during the extension if applicable, right? So, and minimum interest, basically bank wants to get the commitment that you are going to keep that loan for at least 18 months, right? So capex reserves, working capex. So bank wants you to put some reserves in the capex, so working capital, cash management. So they write everything basically. These are their standard template, they want you to buy interest. So it is bridge loan. They want you to buy cap rate, insurance requirement, they'll give you the interest requirements. They say break of fees, any additional closing conditions. They write down everything. I mean, whatever they could in the LOI. And once we sign the LOI back to them, at that time we would deposit some funds. Basically, they want some money to be deposited so that they can continue with their underwriting. And if their underwriting is uh, obviously done, they want to use the money that you are depositing for third-party reports, legal retainers, due diligence fees, things like that. So they want all that from you. All that is ordered. These reports have come back now, and they have put together the package to be presented to that loan committee, right? Once all the reports have come in and the writing is complete, that package go to loan committee, and the loan committee approves the loan. Again, this is just a letter of intent. It is not a commitment. Once it goes to the loan committee, at that time, once it is approved, yeah, you go towards closing. Hopefully by then you have started raising capital, or your capital is secured for the down payment. And at that time, you are able to, once everything comes together, insurance has come back, third-party reports have come back, loan committee has approved the loan, you are ready for funding, then the closing occurs. So at a high level, it's a big undertaking to more than single family homes, multifamily. These are bigger projects. They take a long time to find good projects, and that's how we close them. Having said that, I mean, this was my presentation for today. In addition to that, in addition to that, I basically have, I mean, we are in this syndication business. We have a deal that we have closed. I wanted to take only 3 more minutes, and then we can go into question and answers. We have Archway Apartments, 106 unit in Riverdale, Georgia, which we have bought already. The property is already closed. We had bought it, with some equity that we have put in. We are backfilling the equity. The highlight of the deal is that it has very attractive debt rate. That is the real highlight on this deal, is the debt rate in today's market. While the rates are 5.5 to 6.5, the rate on this is 3.79 because we have assumed the current loan. The purchase price is 13.4 million. Overall returns on this deal are looking at about 7% cash and cash return. It's a 5-year hold, and annualized return over 5-year period, including the cash flow and the appreciation in the building, is about 18%. So, and all that, when we calculate, internal rate of return is about 15%. So it's attractive debt rate at 3.75, strong cash on cash. Current ownership has completed 60% of the value add program, giving new ownership the opportunity to capitalize on a proven strategy. So 60% units are already upgraded. We have 40% more plus some exterior work that needs to be done. And so if you see here, if you remember, if somebody invests in 1,000, basically this is just an example based on our underwriting. The cash flow in year 1 is a little low, but after year 1 it becomes 7.5, 8.9%. These are cash and cash returns. And year 5, when we exit, at that time, you make about 65%. In year 5, your capital is returned, your 100,000 is returned here. In addition to that, basically, you get this much return: 4,000, 7,000, 7,000, 8,000. So overall return is about 92% on the invested amount. This is a 506C deal, so accredited investors only. We are looking for general partners also who can come join our team and help bridge the gap in the equity. If anybody is interested, please feel free to reach out to me directly. I will write down my email address and my phone number in the chat window. And my phone number is 631-428-6479. Again, we are looking for limited partners as well as general partners who can help raise the equity. Overall, the deal is stable. There are no risk because we have already closed the deal. Anybody comes in, money starts working from the day they come in for them, right? So again, if you want to invest in this deal, the rightmost QR code, invest now. You can use that to go to our website and our portal. And if you want to, register for the future webinars, you have the webinar QR code. And basically, if you want to see the presentation for this, actually, these are Archway webinar anyway. So Archway's webinar, Archway presentation, and the invest now. All the 3 QR codes are here. So feel free to take the screenshot of this and let us know if you have any questions. I'll repeat once again, about 92% return in 5 years on your money as a limited partner. But if you come in as general partner, we would be willing to share the general partnership compensation with you. So pretty stable deal. Already 95% occupied, 85% economic vacancy. We will have to do some evictions, but that's the name of the game. We have done 7 deals in Atlanta with over 18 to our returns have been from 18 to 37% annualized. So we are very comfortable with this market. This is one of the rare finds. The property is already under our control, so there are no risks left. Expenses are fixed because interest rate is fixed. All we have to do is we have to come in, upgrade few units, start raising the rents. And the most important thing, which is not available in these numbers, is there are 2 things. One is you have cost segregation, tax advantages. We have about 50 to 60% depreciation in year 1. That's number 1. Number 2, basically there is a $3 billion project coming close to this site. The name of the project is 6 West. 6 West, anybody can Google that. And that will improve the demographic even more. So whatever rent projections we are doing, we are definitely sure that it will go beyond that. Although we cannot project it, we are not projecting it in our conservative underwriting. So anybody wants more information about this, the webinar presentation and the Invest Now button here, take the screenshot of it. Please register for next week's webinar. Yeah, that's all I have for you guys. Thank you so much for your time.